Welcome to Season 8 of the FarrCast, bringing you insights into Wall Street, Washington, and the world. Now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It is the 10th day of October. Hurricane Milton came through Florida last night. The stock market made new highs. The Fed minutes came out, and the Fed is divided. A little bit later this morning, we're going to get CPI. We've got news hitting us from everywhere. We're waiting to see, of course, what happens over in Israel and the Middle East. We're not hearing much in Ukraine, and we are 26 days now before the presidential election in the United States. This is a lot to take in, folks. 10-year Treasury, 407. 2-year Treasury, 402. That's a 5 basis point spread, 2s to 10s. The inversion is barely uninverted. Oil is in those mid-low 70s, $73 in that range. Gold, 26, 25. What does this all mean? What does it all mean? I'm going to give you my best take right now, folks. Remember what I've said for 2 months. The most important thing going on in the markets and in the economy is that the Fed has reversed direction. The Fed is no longer removing accommodation. The Fed is not necessarily trying to stimulate. They're trying to take their foot off the brake slowly. This is a soft landing. Landing means lower. We're going down. We just don't want to hit the tarmac so hard we shake the fillings out of our teeth, okay? That's what they're trying to do. Jay Powell did something I've never heard a Fed chairman do. He said we're going to have 2 more rate cuts, one at the November meeting and one in the December meeting. I've never heard it. I've heard him say data dependent, but he didn't say that. I think we're now data independent. We don't care what the data are. We're going to have 2 more cuts here. So he's laying it out. Let everybody get their expectations in line. Markets are trying to talk themselves out of it. Fed minutes yesterday showed that Fed governors, voting members of the FOMC, were divided. About half of them looking for a 1/4 point cut, and it sounded like Jay Powell cast the deciding vote. So let's not try and parse it too closely. They did what they did. It's always in my back of my mind that they don't want to be political. They want to avoid the appearance of any bias. They're doing things economically, and miraculously, neither side has started screaming bloody murder that the Fed is trying to put its thumb on the scale. I think that's a miracle. But in general, nobody likes the economy. Nobody feels good. Americans in general don't feel good about what is actually a pretty darn good economy. It's not bad. We're still growing. Things are fine. And I think the Biden team has the worst salespeople on the face of the earth not to be able to sell this economy. This is a sales job. They need to be out there selling and saying, look, the numbers are good, because the numbers are good. They're not making the sale. Kamala Harris is getting harpooned over the Biden economy. She somehow should have figured out a pretty good way to take credit. So when markets are making new highs, I think you got to remember one important thing. Buy low. This ain't low, folks, and the enthusiasm continues and things continue to creep higher. The melt up continues, and we're seeing a broadening out. So if you're going to continue to invest, and I think you should, but you need to pay close attention to those things in which you are investing, and you need to understand why you're investing in those things, and don't go blindly into that good night. Make darn sure you've got an advisor. Make sure that you're being thoughtful and following your discipline. When I want guidance, when I want to talk to advisors, I do talk to my peers. Kenny Polcari is the chief market strategist for Slate Stone Advisors, and my great friend, the voice of the New York Stock Exchange. I'm sorry to go on so long, KP, but I had a lot to cover today. Welcome to the FarrCast once again in season 8 now.
Listen, that's wonderful. Congratulations. And it's always a pleasure to be here. And I should tell you, while you were on your dissertation, bond yields have ticked at 4.09%. On the 10-year bond has now traded up and through 4.08, and we're now 4.09.
And you know that people listening to this don't understand why you and I would care about 2 basis points on 10 years. They're going, why is Kenny getting it? Why? Tell them why.
Well, the trend, more so because the trend is up, right? We only broke 4% 2 days ago. And now, actually 3 days ago, right? On Monday or late Friday, we broke it. But one way or the other, we broke 4%. We're now up and through trendline resistance at 4.07, which suggests that bond yields are going to continue to march higher.
Okay, I can hear listeners shouting right now, Kenny, wait a minute, Farr. Wait a minute, Polcari. This doesn't make any sense. Farr just said that the Fed's cutting rates, and Polcari says the 10-year yield's going higher. Why?
That's correct. So there's a couple of reasons. And I actually put this in my note this morning, this whole conversation about what it could mean. So it could mean a couple of things. It could mean that investors are anticipating that we're going to get inflation's going to rear its ugly head again, and that the Fed is going to have to be forced to raise rate. It could also mean that we've got a hot economy, and that investors then have to expect the Fed's going to either have to slow down and not cut rates anymore, and actually start to raise them, not to fight inflation, but to try to slow the economy back down again. And I think that's where the confusion is in the markets. Ever since JJ told us we're cutting rates on September 17th, bond yields have done nothing but go up in anticipation, I think, of it. Could also mean that the government's going to start spending a whole lot more money. And by the way, both candidates have said that they plan on spending money, which means Janet Yellen's got to bring more bonds to the market to pay for this. More supply is going to force bond prices to go down and bond yields to go up. So there's a little bit of a back and forth here with the bond market and the equity market, because the equity market continues to kiss new highs. The S&P kissed 5,800 yesterday, which is a brand new century mark. Right now, today it's backing off a little bit, yet bond yields.
Yeah, but that's what it does. It goes up, it kisses, it backs off a little bit, and we take another surge. And if we don't get through it, we establish resistance, and that's okay. But that stair-step pattern has been stepping up for quite a while,
100%.
And so, okay, we've got some stocks that continue to be expensive. NASDAQ stocks did not perform as well as the Dow stocks yesterday, which is very odd. When I see that, I say, well, the risk trade is off, but it's not really off. It might.
No, it's not really off.
Huh? It's really not off, because you've got NVIDIA as an example. As an example, ladies and gentlemen, it's just an example, going and making still like almost new highs over $130. So this is a lot of strength in some of these leading companies, but a lot of the other companies that have been reporting earnings are still doing okay. We're at the beginning of this earnings season. So what do you expect, Kenny? And tell us what you're thinking about as an investor. Are you putting where are you putting new money to work?
So I'm not putting, to your point, when you said buy low and don't chase stuff that's either overvalued or stretched. So I am not putting new money in those sectors that are overvalued and stretched. Tech being one of them. And by the way, utilities, which is the most boring sector in the universe, is up 25% this year, right? That the most boring sector is almost the most best performing sector. A lot of that driven by the expectation of lower rates, also driven by the demand on energy by data centers and AI and all that. But they've had a nice move. So you got to look to other opportunities. I think let's get to earnings first. I think earnings revisions have started to come down. I think we started the year thinking that we were going to have like 7% year over year earnings growth in the third quarter. I think that's now closer to 4.5% or 5%. So earnings estimates have come down. I think that's going to make it easier for companies to beat. Look at this. Domino's Pizza reported this morning they beat by 15%. Delta Airlines reported this morning. Now they missed it by a penny. It's going to be interesting to see what Delta Airlines has to say in their earnings report, when they were actually quite bullish on what the outlook was going to be. It's really going to be more on what's the outlook, right? What's the guidance?
So what are you doing? Give me your outlook. I mean, do you think we're staying on a positive course through year end here? Stocks going to end higher than they are right now?
I think stock's going to end right here, right? I think we're going to churn a little bit. I know there are estimates as high as 6,000 on the S&P. I'm not that bullish. I was somewhere in between 58 and 5,900. We're at 58 right now. So I think we probably pull back just a tiny bit, because I don't think the Fed's going to allow the market to really correct. I think that was obvious in the September 17th Fed meeting, as well as yesterday's minutes, because it was a split decision at the FOMC where the chair finally made the deciding vote to cut rates by 50 basis points versus 25. So I don't think the Fed's going to let the market really back off. And I think, therefore, we're going to end probably right about where we are now, which has been a great year, by the way. The S&P's up 21%, the Nasdaq's up 22%, the Dow is up 12%. Has not been a bad year. But I would be very cautious, kind of chasing the runaway names. I would be in consumer staples. I would be in financials. I would be putting more money into healthcare, because those are all, while they're up for the year, they're underperforming the market.
What do you think about next year, Kenny? And then we got to go.
So I think next year is going to continue to be, I think the market's going to do okay. I think the earnings are going to grow somewhere between 8 to 10%, which should put us like in, I don't know, maybe 60 to 6,300 for the S&P. And I think that's fine. But again, I think you have to be more defensive next year than you do sexy growth. You should still have it, but you should build a more defensive portfolio.
Okay, more defensive portfolio, according to KP. He mentioned his note this morning. I read his note every morning. I think you probably should too. It'll prepare you, understand what happened yesterday, and give you context with which to face the new day. It's not, you can talk to a lot of people in our business. It's hard to talk to people with 40 years of experience who still have been doing this every day and paying attention every day. Kenny's a gift to all of us there, and he'll talk to you. So I'm just telling you, if you need to talk to somebody, Polcari. If you want to read a daily note, call Polcari. I mean, the daily note's free. You get a good market recap. All right, Kenny, thank you for joining us in season 8, and we'll talk more soon.
It's always a pleasure, Mike. Have a great time.
Coming up, Mahaffee. Stay with us.
Thanks for being with us this week. Now it's time to go to our political analyst, Dan Mahaffee, and your host, Michael Farr.
Welcome back. Joining us now, as he does every week, the vice chairman of the Dr. Scholl Foundation, the scholar from the Center for the Presidency and Congress, and the senior political analyst now in season 8 of the FarrCast, where we cover Wall Street, Washington, and the world, Dan Mahaffee. Welcome back, Dan.
Good morning, Michael. Thank you.
27 days till the election, Dan. 27 days till the 26 days, I think, yeah, until the election. On day 27, I don't expect to really know who the president of the United States is, or president-elect anyway. You said last week, flip a coin 3 times, and then you tell me. Where do we stand now?
I think we stand right there. As you point out, we're so close to Election Day. In many ways, it's already started. I've got my ballot in the mail now. There are folks already voting. But yeah, we're still at this point. Knife's edge, nose and nose, whatever metaphor you want to use for this election. We're there, and it's now basically down to the thoughts and emotions and logic, whatever you want to say, of these undecided voters, probably 80,000 people or so across these 7 swing states who are going to decide this. And right now, I think you see both campaigns are confronting, look, as we get closer to this, they're confronting their fears. They're looking at what they see. Sure, for Democrats are nervous headlines, I'm seeing those. Look, if I had $1 for every one of those, Michael, we'd be at my house in Bora Bora right now instead of on
the
this show.
island that you own for nervous Democrats. Go back and break down something for me, Dan. You said this election's going to be pretty much decided by 80,000 people, 90,000 people, 80,000 people across 5 states, 7 states. What'd you say?
Yeah, about those 7 states. The ones we've kept talking about, Arizona,
10,000 people. 10,000 people in each state.
Roughly, yeah. 10 to 12,000 people. You think about these margins.
Presidential election, the fate of the next 4 years, all of that's coming down to a few people. And as you say, voting's already started. Why? Tell me why that's so important. These 7 states, why are they so important? And how can 10,000 people in each one of them, and I know it's not going to be mathematically, average there, but how are 70,000 or 80,000 people going to determine the fate of this country?
Well, it comes down to the math of the Electoral College. And these are the states that are, not going to be clearly in one camp or the other. This is where all the money is now going into the final days of the race. I'm seeing some of these when I get up north to Wisconsin. So it's truly a barrage of ads from one campaign to the other. And this is where it's going to be decided. The marginal states, who gets over 270. You do the math a lot of the time. Pennsylvania, critical each time. But look, the Harris campaign, you look at their concerns, are that you see Harris in those states, critical northern states, the blue wall, as they say, Michigan, Wisconsin, they're still not breaking 49% in those polls. And that makes them worried about the undercounted Trump voter. On the other side of this, though, on the Trump side, yes, you've got worries about energy there. He's seeing the energy at the rallies. He's seeing the difference in the crowds there. There's concern about that. They're also concerned about a latest poll that shows Harris has pulled ahead in a poll of suburban districts. Those are the key areas outside Philadelphia, Atlanta.
Why are
Phoenix.
suburban districts? Why suburban districts?
Suburban districts are the swing districts. Cities generally, rule of thumb in politics. Cities reliably go blue. The rural areas reliably go red. And it's those purple suburbs where you have to get votes to swing a state one way or another.
What do you expect there? And normally when you look to those areas, those purple areas, those suburb areas, you've got more college educated, and the woman's vote is more important in those areas.
Correct. Two major headwinds for the Republicans right now: the loss of the college educated voter in the suburbs, as well as how women are continuing to vote about their personal health and autonomy, and seeing those rights as critically at stake in this election.
Did the Trump campaign last time? And did they have those votes from the suburbs? Did they have a majority of those?
Suburbs were much more evenly split in 2016. You see that. You see the suburbs start to go away from Republicans, starting with the 2018 midterms. And that's where you've seen that trend. And for Republicans, though, those votes have been replaced, and you see it in this polling too, by the non-college educated male voter. And that's why Harris's poll numbers look weak. Alternatively, Trump's look strong among those non-college educated male voters. And that's of all races: white, black, and Hispanic.
Okay. I want to go somewhere else here. And this feels like a little bit of a third rail. I can see Harry getting a little nervous there when I say things like that, because he knows I'll go damn near anywhere and don't even worry about it being a third rail. But I had met with some folks yesterday, very bright, very accomplished, in Pennsylvania, and big Trump supporters who are arguing with me that we should let Putin take whatever countries in that part of the world because we don't care about any of them. They don't mean anything to us at all. And he was a very proud isolationist. And I said, I understand the sentiment. I really do. And I understand the money, and I understand the expense. But that's basically a much more of a sentimental argument than a fact-based argument in that when you look at Ukraine and you see they control a huge part of the world's wheat, corn. They have natural resources, oil and ports. They strengthen Russia's position enormously, and make Russia more powerful. And he said, I don't care. We don't need them. Let Russia do what it wants to do over there. We don't need to be sending anything, money or troops or anything over there. And I said, yeah, very, very short-sighted. Moving away from NATO, very short-sighted. There are always bully bad guys in the world, and we've got them in Iran, and we've got one now in China, and we've got them in a bunch of other places. We have to have influence around the world. This is not about us being the world's cops. This is about us maintaining enough influence around the world so we can protect our international borders as much as our national borders, and our international interests economically, that we have to protect that. And these are crucial. And so we think we can get away with being an island, but we can't, number one. And number two, isolationism and protectionism is horribly bad economic policy. You think we've got economic problems now? You go ahead and try and really assert protectionism, and only U.S. solutions to a country that is right now at a $1.8 trillion deficit for this last fiscal year. None of this works. And I'm sorry, sir, you really need to go back to Econ 101 and open your eyes. This doesn't work. What did I get wrong, Dan? Because I'm starting to get on my soapbox.
Yeah, Michael, I think you're spot on about understanding that we live in a globalized world. The economic impact of these things is interconnected and affects us all. A butterfly flapping its wings or a ship getting stuck in the Suez Canal, whatever you want to say, it affects everything that we pay for in our grocery stores and when we fill up our gas tank. Secondly, in our interest, look, I think there is a way to say that you do need to resolve this conflict in Ukraine. It is a human tragedy, a nightmare for the people on both sides, the suffering of the Ukrainians, and even now estimates that the Russians could have lost as many of 1 million of their own young men in this conflict, the senseless violence of it. But also to think that Russia, a country which is not a friend of ours, an open, I will say, adversary, is now facing the loss of 1 million men and its military equipment without the single loss of a U.S. or NATO soldier in combat. So let's be clear about that. We've seen the weakening of an adversary without the single loss of one soldier, airman, or sailor from our countries and our allies. And then I will also add that there has long been, and we need to understand this, a vein of political sentiment in this country that is there, and we cannot be naive that it goes away, that there is a vein of isolationism that has extended. We hear it now, let Ukraine go to the Russians. We heard people once say that Mr. Hitler was happy with Czechoslovakia. We heard that we need not worry about slavery in the southern states because that would not expand further. So there's always been a element in our nation of saying that we need not intervene, and we need to understand that that is an attractive call at times, but one that is overly simplistic nor meets the challenge of our times and the world we live in.
Yeah, it just doesn't seem to work. And a global economy actually works for a lot of the United States, folks. This fellow was also arguing we shouldn't buy anything from China. These tariffs do work because they stop Americans from buying their stuff, even though they are taxes. It stops Americans from buying their stuff, and if they're not selling their stuff, they're suffering. Well, yes and no, but so are the Americans. And by the way, all that cheap stuff from China that people want to rail against and hate is finding its way to Walmart shelves and is very, very affordable. All of these televisions that used to cost you $4,000 that you can now buy for $300 or $250, fabulous state-of-the-art technology, is affordable. You have a higher quality of life because of all of this cheap crap we bring in. We can't make it that cheap here.
Right. And look, if you want to even put up those barriers on China, you're simply going to buy the same good from a Chinese company now based in Malaysia, Indonesia, Thailand, etc. So the reality of the global economy.
They're not thinking that way, though, Dan. They don't think that way. They're thinking, no, we'll just make it here in the United States. We can do anything here in the United States. And, we'll just.
I would love to see the folks go from a MAGA rally to an electronics assembly line.
And you're going to also cut off immigration. Who exactly is going to fill these, assembly line jobs, do you think now that can't be filled? I mean, none of it is well thought out. These are emotional arguments, which I get. I don't want to rely on anybody else, but I really don't. And I believe in American true. I mean, I really believe that America is the most blessed country in the world. And I believe in American exceptionalism down to my toes. And I thank God for all of it. And that I'm as much as a patriot as anybody you're ever going to find when it comes to belief and love for the United States of America. However, I'm enough of a realist to say that isn't the way the world works. Mm-hmm. And it's a nice idea and it's a great story, but it does not work that way. You're not going to run the trains on time at all, if you can run them at all, because you're not going to get parts for them if you think you're going to do it that way. So that's not the world we live in, folks. It's just not. And by the way, the world that we do live in isn't, a lot of it's not working, and we're adding too damn much debt. $1.8 trillion in debt. Going to be paid back by whom? Your grandchildren. I'm telling you right now. And we've got to have more inflation. We need more inflation to handle this debt. We're in a spiral that's going the wrong way. It just really upsets me, and the politicians don't want to talk about it. You want to know why? Because they can't sell it. They can't sell it. An actual responsible approach to debt and to the economy, to healthcare, to Social Security, to Medicare. The responsible numbers are out there. It's not rocket science. This isn't something nobody can figure out. It's something that nobody wants to do. They don't want to face the problem because you don't want to face the problem, and therefore they're not going to talk to you about it because it's not going to get them elected. So to a certain extent, yeah, I blame politicians a lot, but shame on all of us because we keep electing the people who tell us what we're going to hear instead of what we need to do. Dan, give us.
As we say, Michael, that's the bumper sticker version of that is no one won on the eat your broccoli ticket.
Certainly George Bush, 41, would have never voted for you. He hated broccoli. Dan Mahaffee, Vice Chairman of the Dr. Scholl Foundation, our senior political analyst on the FarrCast. Thank you so much.
Thank you, Michael. You're welcome.
We're going to be back with Dr. Jeffrey Lacker, former president of the Richmond Federal Reserve Bank, and see what he thinks about this economic data and this new CPI number when we come back on the FarrCast. Stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast. It is the 10th day of October, the first month of the fourth quarter. We're into the most difficult month of the year now without a lot of difficulty. We got economic data this morning, ladies and gentlemen. Since we started our show with Kenny Polcari, we didn't have the economic data. The economic data started out hot. CPI, the measure of inflation, came in hotter than expected. And then jobless claims came in as a much bigger number. What does that mean? It means that with all of the extra jobless claims out there, it suggests that perhaps we won't see wage pressures. Perhaps we won't see wage inflation at the same rate. There's not the same pressure. It suggests that there's more supply, more people who want to work. If you've got that many jobless claims, we'll see if it's a blip or we'll see if it's a trend. But on CPI, the consumer price index, that's still trending up a little bit. And the core number, which I hate talking about, but when they really boil it down, that number was even a little bit stronger. So has the Fed really engineered this soft landing? It seems like the economy is still okay. When you're still trying to bring inflation under control, it usually means you've got some growth pressures from somewhere. How do we make sense of it? You know, we're so fortunate that we get to talk to Dr. Jeffrey Lacker, the former president of the Federal Reserve Bank of Richmond, Virginia, covered the whole Southeast and the Charlotte banks, had a huge territory.
Maryland to the Carolinas and most to West Virginia.
Big area, huge amounts of money and rates and everything. So, Dr. Lacker, it is wonderful to have you back with your insights. You voted on the FOMC dozens and dozens of times. What what are you seeing? How do you interpret what Jay Powell is doing, what the Fed's doing, and that we got a report yesterday that the vote actually was very mixed, whether they did a quarter of a
Yeah.
point, half a point. I was wrong. I said no, they're going to do a quarter of a point. They needed to pre-sell a half a point more than they have. Well, they didn't, and I was wrong.
Yeah. Pleasure to be on again, Michael. Love talking.
Season 8, by the way, Jeff. Season 8 of the FarrCast. Can you believe that?
Really? Oh my
Yeah.
gosh. You're a vet. You're quite the veteran.
Yeah, or stubborn, one or the other.
Yeah, right.
I just won't go away.
So the data, the data coming into the FOMC meeting, it was pointing them towards a quarter point. Their signaling was all pointing towards a quarter point. There's a thing called the blackout. They don't communicate the week before the FOMC meeting. So the FOMC meets on Tuesday and Wednesday. The decision's released on Wednesday. The whole week before, they're banned from like talking to the press or providing any signals to official signals to markets. Well, coming into that, it was all looking like a quarter point. But then, I mean, Powell indicated at the press conference, he changed his mind in the blackout period, or a bunch of people changed their mind, but not everyone came along. So there were a bunch of people that would have preferred a quarter point to a half a point cut. And there were a bunch who would have gone either way. So it was a close call, and he carried them along, got everyone to vote with him.
In the age of instantaneous information, is it still a good idea to have that blackout period? Wouldn't it be more stabilizing for markets if Powell could have sort of said, yeah?
He actually did, but his
Did he?
fingerprints aren't on it. So there's a house organ. There's one news source who has privileged access. And
yes, at the Wall Street Journal.
It's nowadays it's the Wall Street Journal. It used to be 20 years ago, it used to be the Washington Post. And when they write something that purports to read minds inside the Fed, it's a reliable source because they get better access than everyone else, and in turn they kind of cooperate with the board, and they don't slam the board, they don't criticize the Fed that much. So it's sort of a symbiotic relationship, and it's how Powell can signal during blackout. He can signal to markets, that he's leaning a different way.
So you don't think they need to change that rule at all because they can still whisper to the Wall Street Journal?
Well, there's something a little bit unseemly about it.
Is it anachronistic is more my question.
Yeah, it is sort of anachronistic.
Okay. All right. So tell us, did they make the right decision at a half a point? And what the hell is this? I've never heard a Fed chairman. I mean, going back pre-Greenspan, who will come out and say, we're data dependent, but we're going to cut rates a quarter of a point at the next two meetings? I mean, I've never heard that before.
Yeah. That was a little bit out on the limb. All year, they've been really itchy to cut rates. A little itchier than the data indicates, I think, and supports. And the two big reports they've gotten since the meeting, they've kind of shown the risk of that. They got a big employment report, one that indicates that the downside risk to the labor market isn't nearly what they were saying, a month or two ago. And then they got this CPI report that's way stronger than people thought, than people expected.
Right.
The consensus was like 0.1%. Some people were saying 2. It came in at 0.3. I mean, it's a pretty strong employment your CPI report. So it looks like there's a sizable risk that inflation is gonna kind of stall out around where it is now by their preferred measure, like closer to 3 than 2. And the employment risk, the labor market risks look minimal. I mean, it just doesn't look like there's some fall in employment or rise in the unemployment rate around the corner. Add to that, what they say, they describe themselves as taking out restrictiveness, making policy less restrictive. Well, it's still not obvious how restrictive policy is. And that's a big uncertainty looming over them. So yeah, they're taking a risk by cutting so aggressively.
All right.
The risk is they lose face when they have to reverse course next year.
One of the things you've told us in the past, as have other Fed presidents, sitting Fed presidents and past Fed presidents. One of the things we've heard lots is that the one thing the Fed doesn't want to do is repeat a mistake. They don't want to make the same mistake twice. What mistake, in your opinion, do you think they are most at risk of repeating right now?
So it's the mistake of 1977, 76.
I was going to go back to the late 30s, early 40s, but go ahead.
Right. Yeah. With your
you and I were younger then. Go ahead.
Right. So, they took their foot off so inflation zooms up in 73, 74. The Fed tightens policy. There's a recession, and there's a lot going on. And the Fed turns around and takes its foot off the brake with inflation down around 5 or 6%. And then inflation just kind of starts creeping up from there. The Fed's reluctant to raise rates enough. So it kind of gets away from them. So their risk now is that they cut rates. They don't want to reverse course because they'd lose face. But inflation stays where it is now, doesn't come down any further, closer to 2%. The labor market remains robust as it is. And, they realize into next year that they've made a mistake by cutting too much, and they feel compelled to kind of stick with it rather than admit the mistake and change course.
When we were talking a couple of years ago, Jeff, you were suggesting that they should raise rates even higher and even faster, and that they would need to get to a 6 handle. And it seemed that way to me as well. I really felt that way too. What did I get wrong, Jeff, there? What were you?
What's wrong? What's wrong with what you're saying here? What's wrong is you and I could be right. I mean,
okay. We're not wrong
because
yet.
They didn't do it doesn't mean it was wrong.
Okay. Would you agree that as you look at things now, I didn't think that I thought the odds of a soft landing were, 15% tops, because the Fed never really is able, and that's not that these people are stupid. It's just that this is an incredibly difficult, complex thing to try and get right. I mean, this is an amazingly complex thing to try and get right. So I said 15%. A soft landing's looking in the realm of possibility. Do you agree with that?
Oh, I totally agree with that. And I think the credit has to go to the work of the committee since the mid-1990s to establish and communicate a 2% inflation target and to stick with it through thick and thin, at least until 2021. The credibility that the Fed has established since the 1990s for its commitment to and its willingness to take actions to deliver 2% inflation over time is that I think that's what saved its bacon this time. Back in the 60s and the 70s, so back in the 60s, it was the gold standard that kept inflation under control.
Yep.
And in 71, Nixon throws out the gold standard. We're not going to do that. So now who's in charge of inflation? It's central banks around the world. And they're kind of at a loss. They're politically, it's very difficult for them to raise rates enough to get inflation under control. Everyone's running deficits. And so inflation's heating up. And the central banks are all blaming someone else, oil prices, unions, food prices, and the like. And it isn't until Volcker steps up and says, no, it's the central bank's responsibility to get inflation under control, that he took the strong medicine. He got the political support to do it from Reagan and others and people in Congress, and tightened inflation. And then Greenspan brought it home down to 2% in the mid-90s and established a 2% inflation target. We announced it in 2012. And that's that journey, that long coming of age of monetary policy to be able to keep inflation under control without the crutch of the gold standard has been this amazing achievement. And that's why when inflation goes up in 2021, longer term inflation expectations don't go up.
Right.
People think, all right, this is temporary. Whereas in 1973, when inflation went up, it was like Katie bar the door. We're going down. Civilization's, as we know it, is coming to an end. This is ridiculous. Inflation's going to go on forever.
So okay, so now, do you think that the risk is that it's going to keep them awake at night, that they're taking the foot off the brake a little bit too early?
Yeah, I think
It does. So okay, but Jeff, as I go back and think about what I was suggesting, which was that they needed higher rates, the rates, the 5.3% seems to have. I'm going to go ahead and say I was wrong. I'm going to go ahead and agree that maybe you're not yet, and even though we took the same position, and time will tell, but that inflation came down as dramatically and drastically as it has suggests to me that that was the appropriate amount of pressure on the brakes to solve the problem we were having. Because now they're concerned, rightly or wrongly, as to whether they're taking their foot off the brake too early. But it left on, if they weren't doing this, I think we would see continued slowing as real rates continue to rise as inflation was coming down. How long it lasts? Did they stay too long? Did they send us into recession if they kept the foot on the brake too long? Is what I'm worried about. Now, give me a final word there. What are the odds they've got this right, Jeff, that we're going to have this soft landing?
The missing piece is that inflation isn't at 2. Inflation is well above 2. It's running at 3. Wage rates are increasing at rates that are inconsistent with 2%. They don't look like they're coming down. So it's not clear that they've done enough so far. And they're hoping that the momentum of inflation having come from 7 to 3 is going to bring inflation down to 2. There's still a case can be made for your position that 5.3 was enough and that inflation will come down. On the other hand, a case can be made that if they'd done 6, if they'd gone up to 6, we would have gotten inflation down to 2 by now.
Dr. Jeffrey Lacker is the past president of the Federal Reserve Bank of Richmond, Virginia, professor of economics, one of the smartest guys you will ever hear anywhere, anyhow. And my great friend, you can hear how nice this guy is. He really is. You want to hang out with him. You want to go have a beer, I promise, with Jeff Lacker. Thank you, Jeff, so much.
Well, thank you. It's been a pleasure. It's great knowing you, Michael. You've been a great friend over the years. Really appreciate it.
Don't we have fun? Don't we?
It is.
He makes me a lot smarter, too. Ladies and gentlemen, that's it for another FarrCast as we cover Wall Street, Washington, and the world now in Season 8. We'll be back again next week. Harry Jennings, our producer, everybody at Hightower and Farr Miller in Washington, thank you for listening. Please share us on social media. See you next week. I'm Michael Farr.
Thanks for joining us on this week's episode of the FarrCast. Michael and Dr. Lacker continued with their conversation, and I kept the tape rolling. Look for a special episode coming out in the next few days with the extended conversation, where Dr. Lacker tells us he's not seeing any sign of a recession yet. Thanks to our guests, Kenny Polcari, Dan Mahaffee, and Dr. Jeff Lacker. And thanks to you, our listeners. We hope you enjoyed the show as much as we enjoy making it for you. Please share us with friends and colleagues. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it is not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. And, as always, if we can be of assistance at Farr Miller, Washington, please feel free to reach out to me at hjennings@farrmiller.com. We are here to help, and I'm happy to arrange for any of our listeners an appointment with one of our financial professionals to review your portfolio, your needs, and your goals. We love reading all of your notes, and we try to reply to as many as we can. You can reach us at hjennings@farrmiller.com. Let us know any questions you have about past episodes or questions you'd like us to address as we continue into Season 8. Take care, stay safe, and stay healthy. Thanks for listening to the FarrCast. Wall Street, Washington, and the world. Farr, Miller & Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr, Miller & Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller & Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and/or legal advisors for related questions.